episode on investing on moneypuzzle.in. Today we are going to be talking about debt funds. Now, debt funds have seen a very harsh last 1 year or so. There have been certain bond defaults in exposures that debt funds held, and this resulted in losses for such schemes and also losses for investors who were in these debt funds. However, as a category, debt funds are not all bad. They have a lot to offer investors who want to have these schemes as a part of their overall portfolio. And joining us today for this discussion is Vishal Dhawan. Vishal is the founder and CEO of Plan Ahead Investment Advisors, himself a certified financial planner and a life planner. Hi Vishal. Welcome. So Vishal, you must be aware of what is happening in the debt fund space. However, debt funds as a category themselves still have a lot to offer investors. And what do you think investors should be careful about now, given the scenario of bond defaults, etc.? What should they be looking out for?
So very clearly, I think first of all, there are credit ratings which are available. We know they've got banned really badly, but the fact remains that credit ratings have always indicated the possibility of a default. Somehow we've had this notion that if you have a AAA rating, you cannot default. It just means that you have a low probability of a default happening there versus something which is lower rated. So do look at those ratings carefully. I think they're important. Number two, look at the kind of yields that your portfolio is generating. Typically, high yields are actually an indicator of higher risk. And unfortunately, we are all always chasing returns. So therefore, we go with the highest yield product, and without realizing it, just add much more risk than what we can handle. The third thing is look at the fact that there could be concentration in portfolios as well. And this is important because a lot of portfolios have had problems on the debt fund side. Not because the security has gone bad, but it's because the security has had so much exposure in the portfolio that the net impact on NAV has been very significant. So typically, if you can look at that very carefully, look at not more than 3 to 5% exposure to single security. I think you're in a good place. And last but not the least, remember that it's good to align your time horizon with the kind of debt fund you pick. Sometimes we see people trying to buy debt funds like they're trading instruments, and try to make money because interest rates are expected to go down, or sometimes they buy it as a trading instrument because someone has told them that he made an X amount of money in like 1 month. I think those are not really why you should be using debt funds.
Absolutely. I think they act more as a stable return component of your portfolio, and hence pick the funds that make sense for that reason. So what you're saying is look at the credit rating, look at the portfolio concentration, and also higher the yield, more risk. So understand that before you're chasing after the return that the fund offers. Okay, so now I wanted to also touch upon a subcategory within the debt fund arena, and that's liquid funds. We've recently seen certain regulatory changes being announced in this category by SEBI. However, despite all the chaos that we are seeing in the debt and the bond space, liquid funds actually have remained quite true to character. They've been low risk, stable return, flexible products for investors to use. But the guidelines somehow, make you think that maybe there was something wrong with these funds, and that's why the need for a fresh set of, regulatory kind of changes in this. What's your thought on this? Liquid funds required these changes? Are they, continue to be a stable return, low risk product?
So very clearly we think they are, and I think things getting better over a period of time is normal. I think you have every phone company launch a new model every few months. It doesn't mean that your last model is bad. It just means that the new model is better.
So like sharpening of certain things.
Yes, so sharpening certain things that probably got discovered as time has passed has really been what the guidelines have been about. So I think there are 2 or 3 key things that have changed around liquid funds. One is the possible introduction of an exit load up to 7 days. And I think somehow it has got a lot of news. But essentially, the way we look at most retail investors is they're not parking money away for 1 or 2 days. So whether when those decisions are taken, they're taken like 30 days, 60 days, 90 days. And therefore, an introduction of an exit load over 7 days in our view is really not going to change too much. The second shift has obviously happened in terms of the kind of sectoral exposure they may take. And that's great news, because what you're doing is you're trying to put limits in terms of certain caps of risk, etc., that can be taken. So even if there is the possibility of an accident, you're trying to reduce it to the extent that you can. The third thing that's changed around liquid funds has been the whole piece around how you will publish the NAV. So what used to happen earlier was you had NAVs getting declared every day in a straight line manner. That's changing, because now the NAV can be a little more volatile. But again, over a 30 to 90 day period, that kind of evens out.
So it doesn't change the ultimate outcome in terms of returns?
Yes, absolutely not. And to us, the key aspect around a liquid fund has always been liquidity with very low volatility, and we continue to believe that they are very, very suited to that need.
Right. So perhaps the changes will make it a more robust, low risk kind of product. Of course, one has to watch out for the volatility in the NAV, but it does not change the ultimate outcome in terms of returns over a period of 30 to 60 days to 90 days.
Absolutely.
Okay, great. So one last thing, Vishal. For a first-time investor who wants a debt fund just as a cushion in their portfolio to provide that stability, because equities can be volatile in the short period, what kind of fund would you recommend?
So I think a short-term debt fund is an ideal starting point for most investors. It's suited for anyone who has a 1 to 3 year investment horizon. The volatility tends to be much lower if you hold it for a 1 to 3 year period. And ideally, we suggest to all of those investors that look for, again, funds with high quality underlying bonds. Don't chase yield. It's a big problem here, because you get the riskier securities. Look for lower expenses, because that will kind of impact your return overall. And I think if you end up staying for 3 years, then you could also get some tax efficiencies coming through indexation. So all in all, I think short-term debt funds are a great starting point and should find a place for most investors.
Okay, so a quick recap then. What Vishal is saying is that debt funds still make sense despite the chaos that we are seeing in the industry, but you have to watch out for credit rating of the portfolio. You have to watch out for the portfolio concentration, not more than 3 to 5% per security, and you have to also watch out where the yield is very high. Be rest assured that there is risk that comes with it, so don't get carried away only with return. Liquid funds, despite all the regulatory changes before and after, remain a good low risk stable return kind of product. The changes only perhaps tighten some of those issues, which is a good thing really. And for first time investors, look at short term debt funds. They make a lot of sense, especially if you want to remain invested for a 1 to 3 year period. Beyond a 3 year period, even the tax efficiency kicks in, so that's also good news. Thanks a lot, Vishal, for joining us today. Do leave your comments on which debt funds you invest in, and whether you will continue to use debt funds and short-term debt funds more specifically for your portfolio allocation. Do keep logging into moneypuzzle.in for all your personal finance queries. Thank you.